I'm Paul Skippen, and I'm our Risk Transformation Lead. Joining with me today is Mr. Leon Bloom, our overall Capital Markets and Regulatory Practice Lead. Leon, in this time of unprecedented uncertainty, in your mind, what are the types of challenges that global financial services companies are faced with?
Well, Paul, the onslaught of regulation over the past year in particular has given rise to a huge number of challenges. I think what is different though about this particular wave of regulatory change is that it is likely to have a structural impact on the industry. In particular, any kind of trading business that banks have been undertaking is going to attract a much greater level of capital, and it will really not be an attractive proposition for them going forward. I would be interested in your thoughts, Paul, around the whole issue that I referred to of infrastructure and the reporting on the management and control of risk and the evidencing of compliance, which I guess is a change not so much in regulation but supervision.
There's been a clear change in the tone and the tenor of how regulators are coming in. They're no longer, frankly, accepting a bank at a bank's word. They're now demanding clear evidence that supports that. In the short term, it's frankly quite painful because these are the types of questions that risk or compliance functions haven't had to respond to, and they don't necessarily have the required risk or compliance that they can get ready access to this data and respond, and therefore it's having organization-wide impacts. I think both of us have had client discussions where they're now creating almost a regulator relationship management function on a global basis, very similar to how we've helped companies in the past roll out CRM type solutions. We're now looking at regulator relationship management type functions. I think it's fundamentally changing. Do you see a time in the future where we'll reach a point where we have maybe a little bit more clarity as to what the future regulatory structure might be?
Clearly, the regulatory pendulum has swung and continues to swing in a much more conservative direction, and the cost of compliance, be it additional capital requirements, liquidity requirements, or representations to supervisors, seems to be growing and growing, and I think that's a big worry for investors and investor returns. Where it's going to end, who knows? Paul, how does one go about justifying these investments when they're seen to be purely in response to regulatory drivers and much less so in response to drivers that will enhance bottom line growth and contribution?
From an opportunity point of view, I think that we're going to see some of the stronger countries where they have stronger financial services actually step in and take advantage from a buyer point of view, and we've seen this in a number of different locations. I think there's also, frankly, an increased recognition that risk and compliance is no longer a cost, it's actually a barrier to entry and thus an aspect of competitive advantage. What are the things that a CEO or a board should be thinking about to respond to this level of new regulation?
The CEO's job, I think, is really to identify the highest value creating strategies for the investor. In financial services, that's about identifying the risks to which capital should be exposed and the kind of return or reward that can be gained from exposing that capital to those risks. And I think that the CEO will need to be extremely sensitive to those potential returns, to the risk to which capital is exposed, and we'll have to make some very hard and I think tough choices around business mix if the kind of returns that investors have traditionally enjoyed, received, are going to be sustained.
Check out our paper online and share your thoughts as to the key challenges and key things that you think that a financial services company can and should be doing to respond.